Good morning, everybody. Hope we're doing really good today. Welcome back to the channel. In this video, we're going to talk about options for smaller accounts. Now, I definitely don't think that options are mandatory if you want to get rich and become financially independent. Dividend growth investing in index funds and ETFs will work just fine. And if you are started out, you're just starting investing, you're young and you're starting investing and just building up your account, ETFs and index funds are probably the way to go. Then after that, you can start playing with some individual stocks. And then after that, maybe get involved with options. Or maybe you do have a big account, but you just set aside a little bit to get started with options. So I'm going to talk a little bit about options and a few ideas I have for smaller accounts. Talk about how much I think you need to get started with options. Like position size, diversification, and that kind of stuff. Talk about buying calls, and then I'm going to talk about credit spreads. If you're new to the channel, I'm Justin, and I like to talk about dividend investing, income from options, financial independence, document my own journey towards financial independence. So if you like these kind of channels, I'd really appreciate it if you subscribe to my channel. And if you get anything out of this video, go ahead and give it a like. That'd really mean a lot to me, okay? Due to the nature of options, it can be a bit confusing and a lot of people don't understand, especially in the beginning, the big difference between buying and selling options. People think buy stocks and buy options. And they think it's like a home run thing. You take $1,000 and then you buy something and then you make $2,000 and then turn that $2,000 into $5,000 and then $10,000. And this all or nothing strategy, it tends not to work for most investors. And you can build up some gains for a while and build up a pretty good nest egg, but the odds are against you that it's sustainable and you're ever going to be able to do that kind of strategy long term. But I guess one good thing is if you're 19 years old and you're trying to put $200 into an options play and think you're going to double your money, if and when you do lose all your $200, it's really not a big deal because then you can just go deliver a couple pizzas for a few days and you'll make your $200 back. But if you're older and you're playing with like $1,000 or $2,000, it's much harder to recoup losses from $1,000 or $2,000. That's a month or 2 months of your extra savings that you're gonna have to work for and build back up. I think a good number to start trading the wheel strategy is about $15,000, and that's kind of a big number for some people. But if you're doing it long term and you consistently add money, $15,000 is completely reasonable. And it may take you a year to do it or longer, but we're talking about retirement and, decades of time that we can put towards a strategy. So there's no rush. And so $15,000 is 5 separate positions if the contract strike prices are about $30 each. Because our strike prices are for 100 contracts, a $30 strike price equals a $3,000 position per contract. And then you want to get a few of those so you have a bit of diversification in case something goes wrong. So I made another video up here that I'll link to about 10 stocks. I think it's like mostly stocks and a couple ETFs that have a low value but good option liquidity that you can sell puts on or sell your options on. Now, another way that we can get some exposure to options with a smaller account is with buying long-dated calls or leaps. I generally think that buying options doesn't work, but buying leaps has a lot of benefit to it that could work out. And a LEAP stands for a long-term equity anticipation product. And it's just all it is a call option that's in the money, that's dated with like a year to expiration. 1 year to expiration is kind of like the the rule of thumb, but you don't have to get tied up on whether a leap is, if its expiration is 12 months or 9 months. It doesn't really make too much of a difference, that little bit of difference. The point is that it's dated far out. Leaps also generally are in the money, and they're in the money a ways, so they have intrinsic value and they should not expire worthless. Leaps offer, the benefits of owning 100 shares of a stock, or not owning, but of controlling the 100 shares of stock. You have the leverage of options and then the time to be right. So let's look at an example of a leap and how it works, okay? So right now, shares of Apple are trading at $104. So if you wanted to own 100 shares of Apple, it would cost you $10,400. Now you can buy a leap for the same 100 shares that'll expire in September of 2021. So that's like 360 days out, and you can buy this contract for $2,530. That's 24% the price of the shares themselves. And the strike price is $90. And that means the shares, Apple would have to fall 13% for this contract to expire worthless. And that's the risk, that the shares fall below the strike price, and then you'll lose all your money. But we have a year to go, so we have time to be right. And if you expect Apple to rise in the future, it may be a better idea to buy leaps than to buy the shares themselves. Now, there's a couple things with a leap that we got to understand. So if we have the share price, which is $104, the strike price, which is $90, that means there's $14 of intrinsic value. If the total value is $2,530, we have $1,400 of intrinsic value is what we'll keep. Intrinsic value is what we keep. That's what's in the money at expiration. And then we have $1,130 in time value. And that is going to work against us until expiration. Time value is going to reach zero in September 2021. So our break even for this contract, Apple shares have to be trading at $115.30 in 1 year from now for us to break even. If the shares drop below $90, we lose everything, but we break even when shares are trading at $115.37. That gives us our $25.30 in intrinsic value. So those are the values now. Now let's look at if the price of Apple rises in the future. If in September the share price rises to $120, you have 100 shares of Apple, they will gain 15% in that year. But if you buy the same leaps, you will be up 19%. And then if the Apple share price is $130, if you would have bought the shares, you'd gained 25%, but the leaps would have gained 60%. Now, the reason for these outsized returns is the leverage of controlling those 100 shares with options, and the risk that comes with buying options that they could expire worthless. Now, the next strategy is credit spreads, or some people call them vertical spreads is another name, and there's different kinds of vertical spreads. But you'll need a higher level of permission for your options account, and you're going to need margin on that account too. And some brokers are more willing to give this permission than others. A few different kinds of spreads are credit spreads and debit spreads. Debit spreads are spreads that you pay for, and a credit spread is spreads that you sell. Just like you sell a put, you sell a credit spread. And you could sell a credit spread like you sell a put, where you bet that the shares won't fall down to that price, or you can sell your credit spreads like a call, where you bet that the shares won't go up to that price. But the way a credit spread is different than, say, just like selling a cash secured put or naked put, is that you buy your own insurance. Imagine if we sell a put with a $60 strike price for $1. We can buy another put for 50 cents. That means we keep 50 cents or, $50 per contract. So just like a put, if the shares stay above 60, everything is out of the money and it'll expire worthless. But if those shares fall below $58, then our protection kicks in and will cancel out all the downside risk below $58. So the only thing that we risk to lose is the difference in that spread subtract our premium. So we have a $2 spread, $60 and $58. We sold the 50-cent credit, so our max loss is $150 on this example of a credit spread. And we could do it the same way for the price going up. We can sell a call and then buy another protective call above that to limit our risk in the event that the shares go up a whole bunch. Two big benefits of credit spreads is, one, it limits how much money we have. It's called a risk-defined strategy. So we know no matter what, this is our max loss, and our losses can't be more than that. The loss is only the difference in the spread, subtract the premium we received. And the second benefit is that we can use this strategy on underlying securities of any price. If we want to sell a credit spread on Tesla, when Tesla's trading at $440, we can sell that same credit spread on Tesla like we can sell on anything else. So it opens up all the securities that we can sell options on. So I think that's all I got for this video. Hope you get something out of it. Give me a little like if you learned something. Give me a little subscribe if you would. I'd really appreciate that. And leave a comment down below if you have any other good ETFs that you sell or you trade the wheel on or sell puts on. And then I'll put some other videos over here that'll be really cool. I'll see you over there, and I'll see you on Wednesday, okay? And have a good day, all right?